Welcome, everyone. Welcome to the trade findings and adjustments for Thursday morning, the 11th of February. This is part 2 to the series, how to make exponential returns in portfolios. And I need to start off today with actually going back to, I'm going to go back to the exponential growth curve. What I need you to understand with what we do when we collar trade here at Hurley Investments, what we're doing is we're trying to find a couple earning sessions where earning session things go negative. Maybe we have a flat one. We have earning sessions and things go negative. Earning sessions and things go negative. And we have just this little growth. But someone tell me what happens during those earning sessions when things go negative, when stocks lose 20, 30, 40% returns. What do we do here at Hurley Investments? And again, I'm going to go over, we do use that long put, correct, but yeah, there we go, perfect. If we lose 20% on this one, we're picking up 20% more shares of stock, 30% more shares of stock, 40% more shares of stock. One of the best things to have happen is getting into a stock with us here at Hurley Investments and having you have a year where the stock just plummets. And if we can pick up 20, 30, 40% more shares of stock, that gives us 20, 30, 50, 90% more shares of stock. So that when that stock comes back after a year, year and a half of going down, all of a sudden you see this type of growth pattern in your portfolio. That doesn't mean that we don't beat the S&P for a period of time. We can still have stocks going down and beat the S&P for a period of time. Sometimes we don't. Again, if I'm not beating the S&P 500, I should have more stocks to show you what you're getting for while you're waiting for your stocks to move. This concept is important because true investing, especially for a collar trade, might take a year to get up and going, a year to get these exponential returns. If you expect these exponential returns, it all starts by doing something different. That starts with not doing the overall fund system of Wall Street, asset allocations, annuities, or bonds. I'm not saying there's not a place for these, but it definitely should not be the majority of your portfolio if you need your accounts to grow for your retirement. This is how we, meaning those that are registered investment advisors, brokers, dealers, this is how they fund their lifestyle. It's not how you grow your portfolio. So what's the key, right? It's the collar trade. And it's three simple parts. We buy to open the long stock position. If I was looking to do this today, I would probably choose Disney. I would go to Disney because they have their earnings tonight. And plain and simple, I would just pick up Disney. I would buy the shares. They're sitting at $189.38. First thing I would do, I would buy shares of Disney, $189.30. I'm going to go ahead and use round numbers because it's easy for me to do. And the next thing is I'm going to buy to open the right to sell my stock for a certain price for a certain period of time. If I was looking at Disney, I know I'm going to do it at the March going out in time, 190 strike price. I'm going to pay a premium to buy insurance on my stock. Want to go out to March to get through the earnings event. Little expensive right now. It is $10 and so it's going to be $10.15, roughly 5% of the value of the stock. What I'm buying is that long put option, the insurance contract I'm buying the right to sell my stock at a certain price for a certain period of time. That is what I want to do. I want to do the best I can to protect it. That's going to give me a new cost basis of $189.30 plus the cost of my insurance, $10.15. If we do the math, it should be right around $1.99.45, right? New risk in the trade. I always ask people, what's the risk if you buy your stock? In all reality, it's probably about 50%. It'll drop down to 50%. But technically speaking, every penny you put into a stock is at risk. That's just the way real life is. So, new risk in the trade. Well, we have the right to sell at $190 minus the $199.43 comes into a negative, or I'm going to call it risk, $9.43. Or if I go ahead and take a calculator, right? If I take that $9.43, divide it by $199.43, or I've got $4. How about 4.72% of the total invested capital is at risk? I can only lose $9. Disney can go out of business, and I only lose $9. That's too much risk. I want my risk between 2 to 3%. That's really not too much risk, but really, if we can do a call trade and set it up for less than 3% risk, I'm excited. And I might do this a little bit different, but I'm going to sell a call. I'm going to be obligated to sell my stock at a certain price for a certain period of time. I know my break even is at $199, so I want at least a 10% return, right? Here we go. I'm going to sell my stock at $120 for Disney. Almost 15% higher than where it's currently trading. Someone's going to pay me $206 to $218. You know, they'll pay me $2.12, $2.10. So if I want to lower my risk even more and cap my upside, I sell a call. Selling a call. Selling a call is equal to, I am obligated to sell my stock at a certain price for a certain period of time. Call that we'd sell, the strike price, I'm going out to March as well. March 220. That S in short means you're obligated. And I'm going to get a $2.12 credit. Overall risk in trade, pretty simple, right? You just take your $9.43, subtract the $2.12. Your overall risk in the trade should be something like $7.31. $7.31 divided by 199. We're now equal to 3.6%. 3.6% risk. I usually want 1,000 shares. That used to be to maximize commissions. We don't have commissions the same way. we can now get really cheap commissions. But I usually want 100 shares because it is easier to dollar cost average, or in other terms, add shares with the profits of the protection. I'm going to put up here maximum reward until 3rd Friday in March. Pretty easy. You sell at 220. You subtract out your cost basis of 199.43, and you add back in your credit where someone paid you to buy your stock from you. When you do all the math here, 220 minus 199.43 plus 212. Type that in wrong. Let's try that one more time. 220 minus 190.43 plus 212. Your return is $22.69. Or if you take that $22.69 divided by 199, or an 11.4% ROI, return on investment. So your overall risk is 3.66. You almost have a 12%. It's about what, 2.5 times the upside opportunity. I've talked about the 1,000 shares, right? If a stock loses 10%, I should be able to pick up 10% more shares of stock, 100% completely paid for by the protection. We're dollar cost averaging without having to go and ask you guys for more money. If we were to take a quick look at a chart on, if it drops, where is its first level of support? Here we're trying to determine what a good collar trade would be, right? If it drops, what's going to be a great level of support for Disney? I'm going to actually bring it on up to stock charts really quickly because I think I'm going to like this one a little bit better. Where's your first level of support? There you go, excellent. So we're first looking that the drop could come down to 170. 170 is a pivot point. 170 would probably hit the median line on the RSI. It's actually, if you go down here to the Willings percent R, it will probably be that point because it moves significantly faster, right? We kind of look at this drop right here where it came from the top down to the bottom. You'd probably see this come down to at least the midpoint if the oversold. Could be 172, correct. It could be the 50-day. So it's funny because we can't really pinpoint it, right? But it looks like most likely somewhere in this range is where the stock would fall down to. We've got some proof with the pivot point. We got some proof with the 50-day simple moving average. If it breaks those, where else could it go to? Where would be the next step on the way down? Kind of have to judge, okay, if it's going to go down, where's it going to go down to? Where can I start to pick up these shares at? There you go, perfect. It's probably going to fill the gap, right? Probably going to fill the gap, so we're looking right around 155, could be 158. And if it breaks that one, then we're looking to the bottom end of the range and it's stopping possibly right there. If you kept going down even farther, you know, well, actually right there is probably pretty good. So in your mind, you're thinking, okay, 170, 155, 135. That's where you're looking at this stock possibly going down to if it does not have good earnings. Kevin, could Disney really fall that fast, that quickly? Well, let's think about it. It's now getting a it's getting a valuation that like a tech company, like a media tech company, starting to approach a Netflix type valuation. Has no parks, no cruise line, no real movies to speak of. Yet it just shot up from 120 to 200, basically. Well, 190, right? Wasn't warranted. Could it definitely fall down that far? Heck yes. Kind of looking for fundamentally sound stocks that have big drops in them, right? Our thought process. Drops could be to 170, 155, or 135. If it drops to 170, we still have the right to sell at 190. I'm going to use 1,000 share increments because it's easier, right? Easier for me to do the math. 190K divided by 170. How many shares could we get? Well, if we have the right to sell at 190, can buy back in at 170. This shows me we have 1,117 shares we could buy. I probably, would only pick up 100. 17 extra shares doesn't help me if I can't protect it using that long put. So we're going to buy another 100 shares. We most likely are going to sell our long puts, sell our insurance, buy back our short calls. We don't want to sell the stock and create a taxable event. But this is the theory behind how many shares I can pick up. What if it drops to 155? I still have the right to sell at 100, $90 a share. I just change it to 155, 190,000 divided by 155. That gives me 1,225 shares. So we could buy an extra 200. Goes down to the worst case scenario, 135. All we do is we keep making the adjustments. Hey, it's down to 135. Take 190,000, divide it by 135. Now I come up to 1,407, where we could buy 400 more shares. Let's say it does this for the next 3 earnings, where you pick up 100, 200, 400 shares. One more if, right? If the next 3 earnings you did this and picked up 700 shares, 100% paid for by the protection, you have a 70% increase on upward movement. You're going to beat everyone else that's buying and holding in a fund by 70% when these shares pop and go higher. Kevin, does this really happen though? I can already hear some of you going, it sounds good. It's freaking amazing. The problem is it's time consuming. If we pull in Disney over the last 2 years, let me show you what it looked like. We picked up 10% more shares of stock. We lost the cost of our protection. We picked up 10% more shares of stock. We picked up 10% more shares of stock. We picked up 40% more shares of stock. We lost our protection. So this is twice we've lost our protection, right? Almost picked up 10%, almost picked up 10%. Then our 10, 20, 30, 60, 70-ish percent right here, our 70-ish percent didn't start moving till November of last year. Our 70% didn't move till November of last year. This is a 2.5-year time horizon. If you want to speculate and risk losing half your portfolio overnight, you can do that. And there are returns to be made. But it's not a repeatable process. It is a get-rich-quick scheme, and it doesn't help you. It doesn't help you longer term. It's a short-term sugar rush. Ooh, I'm in Bitcoin. Oh, I'm up $10,000, and before you know it, you're down 10,000. You need a repeatable process. In investing, you need a repeatable process to duplicate over and over to be successful. My definition of successful is not a one-time lucky pick the stock. It's not a one-time lucky Bitcoin's off to the moon, Baidu's till tomorrow. It's a repeatable process that you might have to do over and over again for years or a period of time that will get you that exponential growth. The neat part of our collar trading, you don't take the losses like a fund, like the stock market. You're not down 28%. You might only be down 3 or 4%. Go look at our previous video. You might be down 10 to 12%. Anything made up on the way down is profits on the way back up. Here at Hurley Investments, we've had a heck of a run. Last year was amazing. Hoping for the same thing this year. In fact, we do have a pretty good run this year. We still don't have everything taking off, but No Parker was up almost 8%, pretty much doubling the S&P 500. Bit of a down day today. S&P is down 0.35%. We're down 0.33, roughly 0.34. We're matching it today. But if you're looking for exponential growth and exponential returns, this is the way that you get there. If there are any questions, let me take any questions from you. Could this be your trade today? If new money was getting to work, I would definitely be putting on a Disney full collar trade. Disney very easily could get to 220. Just likely though, or just as likely, it'll probably go down to 155. It doesn't matter. The neat thing about the collar trade, you cheer just as much for stocks moving lower as you would for them to move higher. Oh, if it could lose 20%, I'll get 20% more shares of stock. I've heard clients talk to me, oh, if it could lose 50%, we'd pick up 50% more shares of stock. That is 100% correct. If you want exponential returns, you've got to do something different. This would be a great trade. Fundamentally sound, held back by COVID, probably be up and running by August with the herd mentality, herd immunity mentality. What a great opportunity you have in Disney. Guys, this is how you manage exponential returns. This is Kevin Hurley. I'm glad to have you here today on part 2 of how to achieve exponential returns. Bye-bye.